Good afternoon, everyone, and welcome to TradeStation for today's educational presentation with an old friend of mine, John Kmiecik of MarketTakerMentoring.com. Now, John's going to talk to us about trading covered calls the S.M.A.R.T way, or the S.M.A.R.T way, as they call it at Market Taker. Now, Market Taker is an primary options and futures educational firm. They are not affiliated with TradeStation, but they certainly are friends of the program. So if, as John talks about the way that his company operates, if there's anything they can do for you, please don't hesitate to reach out. Now remember that everything we talk about here at any of our educational webinars at TradeStation, they are all for educational purposes. All the symbols, all the trading ideas, and everything that we discuss are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind anywhere where TradeStation is not authorized to do business. Remember that active trading might not be suitable for you because it's quite honestly not suitable for everybody. And options trading carries a high degree of risk and may not be suitable for all traders. Now, I've included in the chat panel two important pieces of disclosure information that I urge you to take a look at when you have time. The characteristics and risks of standardized options brochure from the Options Clearing Corporation, and another document prepared by our compliance department regarding the other asset classes here at TradeStation. Now, whether you are a TradeStation client or whether you're new to futures trading or a seasoned vet, our one-day Future Stars panel in Plantation, Florida, the headquarters of TradeStation, will provide you with a lifetime of valuable information to help improve your futures trading potential starting the very next day. This panel is designed to provide a comprehensive learning approach to trading futures, and this event brings together an incredible lineup of 6 professional traders who will be sharing their knowledge and their experience and the best ways to jumpstart your futures trading. So join Linda Bradford-Raschke, Rocky Horner, David Stendal, Anthony Credelli, Craig Bewick, TradeStation's Michael Burke, and Larry Williams at the Future Stars 2019 conference on March 8th, 2019. In the top banner, there is a button that says Learn More. It's the registration page for the Future Stars event, and what we have added there is an opportunity for if you're not interested in coming to South Florida. I don't know who wouldn't be if you're in the upper Midwest like I am, but if you can't make it down to Florida, we have an opportunity for you to access the presentations on a live stream basis. So take a look at that, see if that is something that works for you. And then later in March, if you are already a TradeStation user and want to master that TradeStation platform, we have a 5-day program for you called TradeStation Masterclass. March 25th to March 29th is the second session we're hosting this year in 2019, and it is going to be held in our Plantation, Florida headquarters. So you'll be able to take a deep dive on the trading platform, go way beyond the platform basics, study our development and testing tools, and get acquainted with easy language through our fast track programming program on Thursday and Friday of that week. There are guest speakers throughout the week and an awful lot of some very cool social events. So we'll do our best about that, Pam. But we have a plan for that. We're actually coming to California later in the year, so you just sit tight. At any rate, the master class is you can register now. We've got plenty of spots for that March class. Which brings me to our presenter today, John Kmiecik, trader, writer, and trading coach from Market Taker Mentoring, is with us today to discuss the MTM Smart Income System. And I'll turn things over to John right now for the rest of this presentation. Sit back, relax, take notes. We are recording, and so this, if you want to view it tomorrow, you'll be able to do that at the TradeStation website, in the YouTube page, and also if you're a customer on TradeStation today. Thank you.
Well, thanks very much, Don and TradeStation, for having me here. I was telling Don that I barely do these presentations at all anymore. I did a live one in North Carolina, not this past weekend, the weekend before, but it's probably been well over a year since I do these presentations. I'll tell you a little bit more about myself as it goes on, but really I've been in the education and trading aspect and not going out kind of doing these webinars. So it's actually a treat for me to do these, to reach out a little bit. So that's the part that I really, really enjoy. So, all right. Get going here. Yeah, kind of Don pointed out, and I will obviously reiterate that trading and options, as I like to say, life in general as we know it involves risk, is not suitable for all traders, investors, or human beings. So prior to buying or selling an option, as Don explained, you need a copy of the characteristics and risks of standardized options, and copies are available from your broker or by calling that magical number, which is 1-888 options, which is the Options Clearing Corp here in Chicago, Illinois. All right, where I live at least. So, all right. So how's everyone feeling today? Hopefully pretty good, pretty good. Like I said, I'm feeling good myself. There's going to be a lot of psychological aspects in this as well. So as Don pointed out, I'm going to talk about cover calls and the aspects and throw in a little bit more in that. But I'm a big advocate of the psychological aspects, and I'll kind of share a story a little bit a few minutes from now about that aspect. But so I just kind of setting this up, just to have complete or somewhat, can we ever have complete and stress-free investing? No. But how would it feel to feel like you have control of your investing, right? And as I say, like fairly stress-free here. So this is kind of what I'm going to go over with. Certainly, this is something we could talk about hours and hours and hours on end, and we only have a little bit of time here, so I can't completely go over it by any stretch of imagination. But I at least want your mind kind of churning, your option trading mind churning here when I go over some of this stuff here. So just take that into context here. So what I'm going to do with you is I'm going to share with you a system that can make trading, but more importantly, not really trading here, because we're talking more about investing here. I'm certainly more of a trader myself, but certainly the aspect of using options as an investor, to me, it goes hand in hand without a doubt. So I'm sure a lot of you guys would like me to share kind of this program, this system with you, and that's exactly what I'm going to do with you guys here today. So I'm excited to bring that to you. So now, having a system is key to anything you do. It's not just trading. It's not just trading. Being able to replicate, of course, a successful system is always the key. It obviously increases your odds for success having a system in place. So when I work with traders, and that's basically what I do. I do a daily trading class for almost 8 years, and I do a lot of one-on-one coaching myself. But to me, a big aspect of that training is having a trading plan. Trading plan is key, because if you don't have one, or if you have one and don't follow one, in my opinion, you have zero chance to continually extract money from the market, right? And that's our goal as a trader, to preserve your capital and extract money from the market. So having a system in place like a trading plan is going to give you eons above most people. And for me, it took me a while to cross that bridge to write a trading plan here. So to me, I'm a big food person, a big wine person, and I always, I use this analogy of looking at a restaurant. I was in North Carolina giving an AAII investor group, and I have a buddy that lives in North Carolina. We went out to dinner, and we sat like at a kitchen table where you can see the kitchen functioning. It was just completely interesting to me. I've seen it plenty of times though, but just how the restaurant flows. How do they keep everything organized? Well, clearly they have a system in place. They have a system in place. That's how it could be functional, because it would be a madhouse if you didn't have a system in place, right? And that's exactly what I'm going to kind of show you here as well. So, all right. Now today, what time we have here, I'm going to show you how to find ideal cover call candidates, right? And how the wrong candidates, I think that's why people are a little bit scared about this, can lead to negative results, right? So you definitely, as I've been talking all about, you definitely want to have a systematic approach to doing this. And in addition, I'm gonna give you some examples from the previous week of some trades, and there's even a cash secured put in there, and that's part of the kind of the system that I'm gonna show you as well. Now, this isn't obviously a system where you do your first covered call trade and you're gonna be rich, right? You definitely have to make a commitment to success here. And this is for decisive people. Now, again, as traders and investors, there's always some indecision, but certainly that's what the system is going to be able to do, make more decisive for you without a doubt here. Now, this is for people that want to invest with confidence, right? Having a system in place. Or don't have years to figure it out on their own. So many times I'll get that. You know what? I'm going to figure it out on my own. Then I'll take some training with you. And I always say, you know what? Right now is the perfect time to do it. Not being a salesperson, but because you finding it out on your own, even though it's going to take time, even through education as well, right? But you finding it out on your own is going to take eons more time here. But having a system in place is going to take that learning curve way down, way down. That's what we hope to do here as well. So, all right, now we look at it. What is an investing system, right? Now, simply put, an investing system is peace of mind, right? It's a peace of mind here. Now, system should be easy to learn. And for this system, it's very easy to learn here. So, and you want it to save you time. Now, you can't put a price tag on learning how to extract money from the market or reduce your risk and so on and so forth. But having a system that works is absolutely going to help you get to that point that you want to be here, right? So, all right. I always forget how to slide this forward here. So let me tell you just a little bit about myself really quickly here. So I've worked for Lynn Waldock, First Options of Chicago, and Goldman Sachs, and I've written a bunch of trade publications and do presentations like this, although I said not as much recently. And actually have taught 4 times for the China Futures Association as well. So been in China a bunch of times teaching them how to trade options. So I really like that aspect of it. Like I said, the education part to me is such a huge factor because it was such a learning curve for me. Now, Dan, who actually is the CEO and owner of Market Taker Mentoring, he's written a couple books that you might have heard of. Market Taker's Edge and Trading Option Greeks. He's certainly been on Bloomberg and Fox Business and all the others, and of course written a million articles as well. So he's actually written a system here as well. So yeah, and it's me all the way on the lower left-hand corner. So yeah, I really enjoy that aspect of it, the learning part of it. So, and this is kind of what I mean. So would it be all right if I kind of share a little personal story with you? And this is really just kind of what I went through. Now, when I left, let me go back there real quick. When I left Goldman Sachs, they were moving my department in New York, and I was born and raised. My family's here in Chicago, so I really didn't want to go. So just kind of took a package to leave, and I really didn't know what I was going to do. But trading, of course, since I've always been around it, working on the floor, so on and so forth, being a retail trader was certainly something that I was unprepared for. And again, getting back to the psychological aspects of trading, just the emotional part of trading, it was completely new to me. So for years, I didn't do horrible, but I kind of broke even for a long time. So probably a good 5 years. And part of that was not having a system in place. In other words, a trading plan. So I said to myself, you know what? I have to take this, trading thing to make some money here, right? Or I'm going to have to go back to kind of a full-time job here and so on and so forth. So what do a lot of traders do? They get bigger in size, right? And I'll still remember that day where, now don't get me wrong, I didn't lose every single thing I had. I'm not going to exaggerate on that front, but I just remember having a fairly big position on. The position went against me more, and of course, always kind of doubling down. I had a huge position on. And I remember thinking the next day, I definitely needed the market to gap higher or move higher for me to be in a good spot. So wake up the next morning, kind of making some toast here, take a look, and the futures were down huge. And I'm just like, I knew that was going to be the end of at least the money in that account, or most of it at that point. So So it was kind of almost poetic that, it kind of burnt the toast. And, I lived in downtown Chicago. I heard sirens in the background. And I just knew that was kind of the end, at least at the current time, unless I made some changes of my options trading career. It was almost poetic. And sharing another story is funny because when I was out of control, we had a door person and people would walk by my door and ask the door person. I knew her pretty well. I'm like, what is that guy doing 405? He's always screaming and yelling. And that's because I was just completely undisciplined at that point. So what I do, after the tears wore off, I said, you know what? You have to write a trading plan. You have to follow a trading plan. And the best thing I ever did was hire a trading psychologist. To me, it was the best $7,000 I ever spent. Flew out to Vegas multiple times and worked with her, developed a system with her, and developed a trading plan with the help of her as well. And it got me to a point where I consistently extracted money from the market. Now, what I also found out, what I went through, I kind of want to share with others. So that's what got me into the educational aspect of this, because I just was unprepared completely on multiple levels without having a system in place for what was going to happen. So what was going to happen. And, sharing that experience just made me, in my opinion, a better teacher and a better trader. And over the years, it's certainly, I still trade every single day. I run a trading class every single day as well. I'll tell you a little bit more about that as well as we go along here. So now, many people tell themselves that income trading is too complicated. And, and that's some of the kind of objections I had in North Carolina with this AAII. Now they're very, very, very conservative. I'm talking to the head. I know the guy pretty good. And he's like, if they're in a trade 15 years, that's probably a short trade for them and stuff. So, but to me, that's why I wanted to show them how simple a trading plan could be, or a system could be if they do it. So, a lot of traders suffer from analysis paralysis. I'm sure you've all heard that. But like I said, if you're decisive, and why you're going to be more decisive if you have a system or a trading plan in place. So, overthinking things, especially after some losses, obviously leads to missing out on taking further profit taking or further risk prevention trades as well. So smart traders are absolutely action traders within reason, right? Not being misguided action traders, but system guided action traders here without a doubt. So here we are. Here's what I'm going to talk about a little bit today. Again, we could talk about this for hours and hours, but I at least want to touch on this as much as I can. It's the SMART income system here. So basically, it's going to be a full, complete system. It's 5 modules that you can watch. They're probably about an hour long, each one of them. And really, you can quickly catch on. And that's a part I like. I didn't write this system, Dan did, but I've certainly helped them perfect it and go through it. And to me, it was pretty fair. And that's what we worked on together, just simplifying it. I always like to say, as an educator, an option educator, I like to break it down 2 ways. I like to give you the politically correct answer, like, why is this negative gamma? And then I like to give you the common sense answer, like, all right, what does negative gamma mean? And to me, that's where I try to, push Dan and kind of simplify the SMART system as we went along here, and make it as simple as we can be for a cover call and a kind of cash secured for investors to use on a regular basis here. So, all right. Come on. All right. So now with that in mind, kind of touched on this already, what is your 2 goals as an investor? Okay. We kind of touched on this already, right? To increase profits and to lower risk, right? And you've always heard, as I mentioned already, the main goal here is to preserve your capital, right? As I first started out as a retail trader, I'm like, preserve your capital? I'm not here to keep what I have. I'm here to make more money. But when you truly understand, and to me, I always use this line with especially my one-on-one students here. I say, when you truly look at yourself as a risk manager first, you've crossed over a huge bridge as a trader investor. And what does that mean? Well, that means about removing risk efficiently and as quickly as you can within reason. Not like I did in the old days. I was a trader that I was up maybe, a little bit on like a long call, and I would take profits, and not because I was ready to take profits, but I was so scared of losing. But you're going to have losses on a trade, right? You're going to have losses on investments. Who's bought shares of stock and the stock moved lower? If you've ever bought stock, chances are that's happened to you, right? So it's going to happen. You just have to be comfortable with that and know what to do from there on out, right? And that's what covered calls do, right? They can increase profits and they absolutely lower the risk. And to me, it's like a no-brainer using them as an investor. So, when I talk to investment groups here, I'm always like, why wouldn't you consider that? It's simple. It's something that you don't have to overly look at as well, but if nothing else, you're lowering your risk. Lowering your risk is always a great thing. Always a great thing, in my opinion. So I just don't know why you wouldn't consider it. And it's surprising that a lot of people won't consider it. It's unbelievable to me here. So the key is to identify candidates where there's credit enough to justify using a cover call, right? And that's a big principle there, and that's where people run into trouble. Now, obviously, there's always the risk of getting called away, the stock getting called away. Now, if you're fine with that, it's not a big deal, right? You could always buy back the stock, right? If you're doing it for tax purposes, which I'm clearly not getting into here, because I'm not a tax accountant, that's one thing. But there's ways around that as well. Now, of course, there's always risk of holding stock. You buy the stock, drops in price, right? Well, I'm an investor, right? I don't plan on selling this right now anyway, and the stock continues to drop. And there's a point you're like, man, I should just cut my losses somewhere at this point, right? But using covered calls can reduce risk. Now, volatility, if you ever heard that, if you know a little bit about options, we're going to cover the basic covered calls here as well. Volatility is basically option pricing. It's option pricing. Now, in general, the market, there's low implied volatility right now, meaning option prices are pretty cheap here. So it's kind of like a catch-22 situation here. I always say in option trading, everything you do is risk-reward trade-off. If you have more risk, you have sometimes bigger reward. If you have bigger reward, you have more risk. And if you have greater risk, you have a greater probability of being successful, and vice versa. If you have a greater profit potential, you have less risk of being successful. So everything's a type of candidate here. And it's the same thing with cover calls here. If the stock is volatile, it might be a worse candidate here, right? But if it's a more volatile stock, your option prices should be more expensive, which again, would you rather sell more expensive premium to bring in more and lower your risk on a trade here? So like I said, everything, and that's what kind of what we're going to talk about a little bit here today, and that's what the system will cover in full detail. So, all right. So jumping ahead here, let's look at nail the trade criteria here. So, all right, now a couple things we're going to kind of cover this as we go along here. Stocks, it's looking for stocks or ETFs that are optional, of course, that are non-volatile or within your volatility criteria. And again, what's that criteria? We'll kind of cover that a little bit as well. In general, it's not a hard, fast rule, but generally you want prices at $30 or more on your underlying, your stock or ETF here. And again, we're going to talk about a little more detail. Now, we're always looking for overpriced volatility, but if there's overpriced volatility, there's probably other things going on as well. And again, that's where you need to know a little bit more about what's good, because again, sometimes covered calls can lead to losses here as well. Generally, we avoid earnings on covered calls, although you certainly could use them over an earnings announcement. As we'll talk about, you're kind of limiting your gains, but sometimes you're protecting your downside on the trade here. Now, of course, bid-ask spreads, if you're not familiar with options, if you are, you're familiar with this, that have bid-ask spreads, right? The difference between what you could buy and what you could sell. It's generally how the market maker makes money. Now, certainly that's a criteria that you don't want to get into a trade and be down too much or sell some premium, and and to buy it back, it's going to cost you obviously more because of the bid-ask spread. So that's certainly something that we look at as well. Now, picking the strikes to sell, right, as part of the cover calls or cash secured put, a big part where a lot of investors make huge mistakes here, right? Between the proximity and the expiration is a couple of the big criteria that really messes people up and leading like, I can't do this, or I don't like cover calls at all. So the make sense factor. Now, a lot of things are intuitive in this world, and a lot of things take time. Well, this is one of those ones here that possible 2 slides before. Yeah, sure. Where you're going to learn it over time. And part of the system is clearly going to get you that plan. And again, what is your overall plan as well, right? So you want this one? We're going to show this guy again as well then too later down the road here, and I'll go over each kind of criteria as well. So yeah, see if you don't catch it right now, you'll catch it coming up here as well. So you're welcome. All right, so let's do a quick covered call review here for those that are kind of a little unfamiliar, but it never hurts though. We'll quickly go through this. So generally, you own stock, right? That's the first general principle of a covered call. You own stock and you sell a call against your position. Generally, options are worth about 100 shares or 100 shares. So basically, if you have 500 shares, doesn't mean you have to write a call, 5 calls for all 500 shares, but generally that's, you know, something to consider here. Clearly an investor-oriented strategy because you own shares, unless you're day trading, which of course is different here. But yeah, it's investor-oriented more than a kind of a swing trader, which I predominantly am myself here. Generally, I think most people would consider it a conservative investor strategy. Most people. Doesn't mean you have to agree with that. We all have different opinions, but for me, I definitely would consider it more of a conservative investor strategy here myself. All right, now a couple of the good things about here is, well, what might be beneficial, right? There's got to always be benefits to taking on risk, right? There's got to be benefits. Well, as a general rule of thumb, just from some reports and white papers and this and that, generally cover calls can outperform long stock. And I'm going to kind of show you this a little bit as we go along. Actually, some real examples from the last couple of weeks here. Lowers the standard deviation because you're selling premium, right? Now, you buy stock, it drops a penny, you lose a penny, right? Goes up a penny, you're up a penny from your original investment, right? Well, since we're selling premium here, you're actually going to lower the standard deviation of your overall position, which is, in my opinion, a benefit here. So can generate income on low volatility or even high volatility stocks in ETFs. I mean, just think about it. Your stock trades sideways. What do you make on the stock? Now, you have no plans on holding it. Maybe it's a great dividend paying stock, but wouldn't it be nice to bring an extra premium as your stock kind of trades sideways or even goes lower when you have no thoughts of selling the shares anyway, right? Now, clearly, as we mentioned, we're lowering the standard deviation because we're lowering the cost basis, because we're selling premium against our long stock position, right? That's a great thing here. And another thing, which a lot of investors that use cover calls don't think about, is you could actually use it for an exit strategy, which is great. Now, we're not going to talk about it here, but it's talked about in the system. But you actually could sell a call that's in the money, lower than the current stock price, and you kind of can bring in a premium there. And even if the stock drops, you can still get out basically for a higher amount because you sold that premium against it. And that's kind of covered in that SMART strategy. Again, this is something we could talk about and explain for 20 other stuff here. But yeah, you can use it as an exit strategy, not just in the money, but even like at a target level, like a resistance level as well. All right, so let's look at an example here. So again, it's not like a one-trick pony, and that's what I love about cover calls. And on a side note, I always say, you know, if you're an investor, to me, and again, obviously, I love options. That's my world. But I don't know why you wouldn't consider. You know, it's not, you don't use them at all times, and that's what we're going to kind of talk about. That's what the system covers here. But why you wouldn't consider them is beyond me. You know, if you don't want to be an option swing trader, I can understand that. But as an investor, to me, it's really a no-brainer to at least consider them or use them at certain times here. So let's say we own 100 shares at $70. So let's say we've even had these shares, or it's, you know, we bought them at 40 and they're up at 70 here. It doesn't matter, right? And we come in there and say, all right, well, let's sell some 75 calls, right? So we're selling the right to buy the shares at 75. Now, clearly, if the stock stays below 75 at expiration, that call option expires worthless because nobody wants to buy the shares for 75 if they're trading less than that. So by selling that call option, we bring in credit of $2 or $200 in real terms here. Now, the intent, and again, there's different intents. Every investor has different intents here as well. You may hold shares after May expiration, and you're okay at selling them above $75. All right, we're going to go over a P&L diagram on this too. Now, we're going to have less volatility risk because why? Well, because we brought in a credit of $2 per share by selling that May 75 call. So clearly, we're going to have a lower cost basis after the call expires, right? So pretty simple, pretty straightforward, in my opinion, just trying to kind of get the gist of this thing here. Move this guy up here. All right. So here's a profit and loss diagram, right? We've got our 75 strike here. Motor this guy along here. All right. So here's our break-even point. Right? So the stock's at $70. We bring in a $2 credit per share. So that drops our break-even point. Now, again, if we didn't have a covered call on, it drops $1, we're down $1. Again, we may not have any intent to sell it. Don't get me wrong, right? May not have any intent to sell it at that point. But here, you've lowered your break-even from where the stock is currently trading up until May expiration by $2. Now, as I mentioned to you earlier, everything has pros and cons with option trading, right? You get this, you give up this in return. Well, if we don't have a covered call on, what's our max profit on the stock? Well, it's infinity, right? It's infinity. So the stock can go up forever. Now, if we're selling that call option, it's going to be taken away at $75, right? But here's the key. Here's the key. And that's kind of the P&L diagram, right? Because obviously, if you don't have the covered call on, it can go up much, down much. Now, with the covered call on, it's not obviously completely protecting the downside, is it? No. So we sold the call, which gives the owner the right to buy the stock, and we have the obligation to sell it at 75, but it can't protect your stock position. There's talked about on some other parts of the system, there's collars, that can protect that aspect, but a covered call doesn't do that here. But in this particular case here, whoops, I'm going to jump that ahead here. Yeah, we actually, if the stock goes up to 75, it's like getting $2 more per share. Now, again, that's the best case scenario, that the stock closes right at $75. Our short call expires worthless. We keep the $2 premium, and we made $5 per share from the stock moving from 70 to 75 plus that $2 share. So it's actually like making $7 per share. Now, even if the stock just goes up $1, well, if you didn't have the covered call on, you're up $1 from your initial $70. But since the covered call expires worthless, you bring in an additional $2 there. So, yeah, don't want to get into too many questions here, but how far in time, and that's part of the system. It just depends, and that's where the make sense factor comes in. That's where the make sense factor comes in, because generally, if the stock's more volatile, you could sell weekly expirations against it. Now, I use the example, my mom has like 600 shares of Comcast. She has no idea what I'm doing, but Comcast certainly isn't a more volatile stock, so I generally have to go out 2, 3, 4 weeks expiration wise to sell premium against it where it makes sense and give enough wiggle room. So that's where kind of that make sense factor comes in, and that's what kind of the system will kind of teach you. And let's be honest with you, once you have that system in place, the make sense factor is going to be something that you get better at time and time and time as time goes by here as well. So, all right. So let's look at the risk reward recap. Now the upside, we have limited profit potential because we sold a call option at 75. If we do nothing and the stock closes above 75, the stock is going to be taken off our hands, right, at $75 a share, make like $5 plus the initial $2 here as well, right? Now, of course, if you don't want to get assigned the position, right, you need to monitor and actively manage. And we talk about that as well, because you could always buy back your short option, right? You could always buy back your short option. So in general, when I sell options, I generally don't want to be assigned because I'm not an investor. So I'll actually buy back the short position. And that's something that we talk about here. Now, the downside, of course, it's the same as owning a stock. If the stock drops in value, guess what? You're losing on that stock either way, right? Whether you sold the call against it as a covered call or if the stock just dropped there. But you need to monitor and actively manage. Now, active, it just depends how active, right? You know, sometimes if it's a more volatile stock, you may have to look at it a little more often. Sometimes I don't look at it for a couple of days, you know, or when I work with investors, you know, sometimes on the less volatile stocks are something that you don't have to look at a regular basis. So again, it's kind of a little bit in your control, but certainly you can't control what the market is doing. But you know, if you don't want to do more volatile stocks, I'll do less volatile stocks and more time. So there's less active management on it. Now I'm going to show you an example a little bit later here. We're using Netflix, and that's something that you actually might have to manage a little bit more. But of course, the reward could be greater on a more volatile stock like Netflix. So again, always trade-offs here. So, all right. Stock rises through the strike price. Good news, right? You made money. The stock moved from 70 to, it's going to be taken away at 75 plus the additional $2. The bad news is, well, what if the stock went up to $90? Well, did you really want to get called at 75 or really 77 because we got those extra $2 from our covered call? No, we don't want to call that basically away at 77 when it's trading at $90. And that's, again, where you have to know when's a good time to sell cover calls and when time's a chance to let the stock run on its own, right? And kind of example I use, which I can't call up some live charts on TradeStation right now, but was like Visa. You know, Visa is one that broke above 145. We're selling calls against it. Now they broke above it. I'm kind of just letting, when I talk to investors, letting this guy run and not selling premium against it since I think it has more upside potential on it, right? So now, of course, managing it, wait for assignment, right? Stock gets taken away if it's trading above $75 at expiration. Or as I mentioned already, we can always buy back the short call, right? Even ahead of expiration. That's the key. And start this process over and over. And I insist more times than not, that's what the system teaches you when to do that. Or roll. Let's do it again, right? Duplicate the system. Continue to sell premium against this. Continue the lower cost. It's just a great thing to consider. There's no doubt about it here. All right. So I promised you kind of that Netflix example here, and here it is. So you already own Netflix stock, and it was much lower. You love being long, you know, maybe, but you know, you're thinking about it here. But you see, kind of it's got like a little resistance level at 325. It's like, all right, with the stock trading at about 312 and change here, I know it might be a little bit hard to see. You come in there and say, you know what? I'm going to look to sell a 325 call where there's some resistance in this case, right? Where there's some resistance. So you come in here and you say, all right, I can collect looking at the 325 call option with about a week and a half to go to expiration. I could bring in a credit of 310. Now, clearly, if the stock drops, you're disheartened, right? Because, all right, you're losing on your investment. Now, maybe you bought the stock at $100, so you're not heartbroken. But, yeah, you still want the stock moving higher. But either way, if the stock drops in value, you're going to collect that 310, right? Now, obviously, if the stock trades up and closes right at 325, that's the best of both worlds. The stock made as much as it possibly can moving up to that level, and then your call option expires worthless. But if you think about it, it's collecting about 1% in 11 days. 1% in about 11 days. Now, can you say this is realistic and do this every 11 days? No. Let's not make a fallacy here and say this is too good to be true. But if you get your mind start working that way on the trade, great. Now, it looks like it's 28 on that one. So to me, I'm not a big setting it up, but you can based on deltas. But I like using support or resistance, and of course resistance for cover calls more than anything. Now, the stock's trading at its all-time high. That's where you might want to consider using delta and so on and so forth here. But the bottom line is you brought in a premium. Now, again, if Netflix shot up to $350, well, there's a couple things you could do, right? You just necessarily don't sit there and let it get taken away at 325, right? You could buy back your short option and roll or leave nothing on, right? And that's kind of what the system kind of teaches you, right? All right, so nail the trade. Stock, of course, in this case, I don't have a problem with more volatile stocks, right? And Netflix is a good example here. Now, clearly Netflix is priced about $30, overpriced volatility. Now, generally more volatile stocks are going to have higher volatilities. As I said, in general right now, the market is pretty low implied volatility, meaning option prices are pretty cheap overall. So if you're looking for cover call candidates, it's a little bit more difficult. This is where you have to make that kind of adjustment and say, all right, either it's not worth selling premium, and here's that makes sense factor coming into play, or I might sell a cover call on a more volatile stock. If you don't own, you don't go out and just buy stock because you want to do a cover call. It's stock you own already here, right? So just be clear on that. Stock you own already. Just don't say, I'm going to buy some stock to write a cover call. You can, don't get me wrong, but generally not how you want to do it though. So, all right. Trucking along here. Here's I promised you again, right? Let's go over this fairly quickly here, right? So simple trade candidate identification formula. So we're basically going to cover this guy because, again, this will take 5+ hours covering all, but I at least want to touch on all these guys as well here. So, all right, the simple trade identification formula here. All right, start there. And again, we're going to focus on what's getting you up and running here, So just think about it that way. So, all right, so truly identify your objective. And that's, again, where kind of the system helps you out with that. But generally, you want to find a stock or ETF above $30. Now, you want to verify that the earnings date is after the expiration that you sell for the cover call. Now, again, you could do it versus an expiration announcement. Again, trade-offs on that as well here, right? Now, as a general rule of thumb, you want to verify, and this goes into the bid-ask spread, that the offer, and this is just a general rule of thumb. This is one of those things that the more you do it, the more you get comfortable with it. You want to verify the offer is no more than 10% greater than the bid. So if the premium that you're selling is $1 to bring in for your cover call, you don't want the ask price to be more than like 10 cents wide. So that's where that 10% rule comes. Now, if you sell premium, like on that Netflix example of 310, you don't want the ask price to be about 30 cents higher, not much more than 30 cents higher, right? So it just depends. It just depends, Jesus, on how volatile the stock is here, right? And again, a lot of this builds into that makes sense approach here. You know, what makes sense here. All right. Now, again, truly identify your objectives. Now, this is the part which gets a little bit, you know, kind of silly here too as well. You know, investors, not just investors, traders lie to themselves, all right? But especially investors. Well, I thought the stock was going to move higher. I was going to try to make money in the next month, but now it's gone down. So let's make this a long-term investment, right? Well, that's the same thing kind of with covered calls here, right? Sometimes it can absolutely lead to unwanted assignment, right? And of course, poor management, which is the key, and that's where people get turned off on this stuff and leading to losses, right? So you just got to understand that aspect as well. All right. So now investors invest capital in equities, right, for longer term, as we discussed. And of course, they hold the downside exposure because that's an investment. I'm not happy that my stock has dropped $10, but this is a long-term investment. I'm collecting dividends here. Now, traders, which I'm more of, well, just trade-offs, right? I'm shorter term, right? I'm more leveraged positions. I'm not tying up as much capital here. To me, I'm more suited for debit spreads here. I'm more suited for debit spreads myself personally as a trader here. So looking at a P&L diagram here, all right, well, a covered call, the stock drops a ton, you're losing a ton. But for me, as a option trader, swing trader, well, I'm buying call and selling call, so I'm limited on my losses. But the P&L diagram looks the same because if the stock moves higher, I sold a call like I would for a covered call. So the most I can make is at that strike price or above. But of course, for me being an option trader, I'm more leveraged to the downside because my cost is the most risk on that trade. Now, same thing with stock, right? You paid $50 a share, you bought 100 shares for $5,000. Most you could lose $5,000, but certainly, you know, you obviously can lose more percentage-wise generally on an investment versus a, you know, kind of a short-term, more leverage opposite position, which I generally do myself. All right. Now, options are based on a percentage of the underlying. You know, there's a Black-Scholes model, how they're priced. There's no reason to get into that. So clearly, the lower the price, that means the lower the option price, right? And of course, commissions can make up a large percentage of the premium as well. Now, bid-ask spreads can be wider, and that's why we have kind of our 10% rule in place to kind of give you a little kind of gauge to kind of figure it out. But that being said, like I said, that's one of those things. I always get to ask the question, what's a good bid-ask spread? Well, 25 cents could be bad for some. It could be great for others. This is one of those things that you're going to learn over time. I promise you. Now, again, the system's going to get you there, but to perfect it, the one thing I can't teach you is experience, right? And no matter what I give you, you're going to teach yourself experience. You're going to know what looks good here. So look at now. Here we bring up our Netflix example. Then we bring up $11 share. Yeah, there's not a lot of premium here, right? There's not a lot of premium here at all. So, all right. Now, earnings, of course, as we just went through another quarterly earnings here, pretty much winding down except for some retail stocks now, is the most volatile time of the quarter. You generally want to avoid volatility and earnings, but can you do them over earnings? Yeah. Well, the trade-off is, guess what? Option prices are going to be more expensive because of the volatility event, the earnings announcement. But if the stock gaps a lot, you're limiting your gain. Now, if the stock gaps down, and you know it's going to gap down, well, you should be a multimillionaire, right? If you know the stock's going to gap down. But yeah, you love it. You sold premium, even though your stock is losing value, but at least you offset some of that loss in the stock price by what? By selling that call against it. So it's just a little bit of help there. But in general, we try to avoid the actual earnings announcement here. Now, as I said, earnings can be after expiration, and generally you want them to be here. We'll select the exact expiration later in the SMART system. You know, I know you guys asked it. Now, again, it depends on it. A lot has to do with the make sense factor, right? Now, can you get away with weekly expirations on a more volatile, more expensive stock? Absolutely, right? Absolutely. So, do you stops in the underlying? That's up to you, right? That's completely up to you. It has nothing to do with a covered call, right? If you're in an investment, you have to draw a line where you think you want to get out of that trade, right? So that's completely up to you as an investor here. So, all right. Now, always want to close, and I say this whether you're a trader or investor, you always want to close out of the money calls prior to expiration. Now, it's okay to hold and accept assignment if it's in the money, but generally, you always ask yourself, is the additional reward, and that's true on any type of option trade or any type of trade, not options even, is the additional reward worth the risk? And that's where when the option is almost down to nothing, no worth, buy back for that small amount and start the process again because you're limiting yourself. You're limiting yourself. So start the process again, maybe at the same strike or maybe a higher strike here, right? So, and again, getting back to the bid-ask spreads here, too wide of markets can make it difficult to make money. Now, generally, the markets become wide when the market moves lower. That's when volatility picks up, but that's when bid-ask spreads generally get wider as well. So, like I said, everything is kind of a give and take here with option trading here. All right, now, as I've said multiple times already, of course, that makes sense factor. It's a simple yes, no. We're going to give you guidelines for that. Not going to lie to you. It's one of those ones, again, that I said, over time, you're going to figure it out on your own. Experience is going to teach you, you know what? This doesn't make any sense at all. This makes perfect sense to me, right? It kind of goes pretty simple on that, right? All right, now here, getting back to our example there, well, it makes sense to bring in 310. Right now, again, the option is a lot more value, but here, is it worth it to bring in 2 cents or $2? Now, I'm not saying that the stock is going to blow by our $12 strike here, but to me, I'd rather not have a covered call in this position in case the stock does move higher, because to me, it's not worth bringing in 2 cents. It's not worth bringing in 2 cents at this point. So, all right. Now, again, the objectives of what you're looking for as an investor, not just as a cover call trader, is a big part of the make sense factor too here, right? Now, again, if you strongly desire assignment or exiting the position, right, you want to sell closer to money, or as I mentioned earlier, in the money too, right? In the money as well. So, all right. And then, of course, trade-offs again, right? Too close in the money means a greater chance of being assignment. So if you're selling a strike price right around where the stock is currently trading, well, common sense would tell you the odds have gone up, right? That you're going to get assigned in that position if it goes a little bit higher, right? Kind of one of those common sense things here. And too far means, well, lower premium, but you have more wiggle room. You have more room for the stock to move, but that comes with a trade-off of smaller premium as well. So, all right. And then, again, that's just step one. Like I said, we could be here all night. That's what the part of the system is for. But let me go over this real quick because I just don't want to kind of make slight of this. And then I want to show you some examples from the previous week as well. So here, max profit option value screening technique. Well, basically, what's good implied volatility, what's low implied volatility, right? It's going to give you a screener to kind of tell you that. So is this good option premium to sell, or is this not good, but I still like it anyway? Getting into the kind of make sense factor here. Choosing the strikes, right? It depends on your objective, and that's where the system takes you through it. You know, and what's the expiration? Well, does it make sense to sell a weekly when there's not a lot of premium here? Well, what's the difference if I go further out in expiration, right? Well, again, it's a smaller decaying part of the trade, but now you have bigger premium to bring in. Again, part of the trade out there as well. When should I get in the trade, right? So the tips for entry and the tricks. All right, well, if I do this, like I said, in the money, well, if the stock even drops, I could still get out for a higher price. So that's what that kind of section 4 gives. And then the last part, how do you manage these guys? Which to me, managing as a trader is the most important part of trading, bar none. I always say there's 3 difficult tasks in learning option trading. The second most difficult is learning about options, learning how they function, learning the strategies, learning the Greeks. The second is the easiest, but it's not easy, is, all right, when do I implement this strategy, like this cover call? And then the third, by far, is the management aspect, because it involves the emotional part of the trading here too as well. So that kind of takes you through that as well. Now, let me show you something here. Let's take a look. I think this is from actually 2 weeks ago here at this point, but let me show you this real quick here. All right. So in this particular example, and I use Netflix again kind of on purpose here. On this particular example, Netflix was trading about 344 and change. So I looked at this on Friday. It was at the close for this past Friday's expiration here, February monthly expiration. And it said, all right, I could sell the 360 calls, right? Basically giving about a $15 room for Netflix to move higher and bring in a credit for a week of 230. Now, clearly, if Netflix stays below 360, that call option expires worthless. You keep the 230. Now, do you want Netflix dropping $10 on you? Of course not, right? But if it does, you're not doing anything with the stock, or if that's your objective, right? You're not doing anything with the stock, but the credit is yours to keep anyway. Now, in this particular case, Netflix, this was just like late in the day on Friday's expiration. And that's what I mean, getting out of the trade. Now, Netflix moved up, what? About 12 bucks, about 13 bucks. So you made money from the stock, but guess what? You bought back your short 360 call that you sold for 230 for 11 cents. For 11 cents. Not bad, right? For essentially doing nothing except selling a cover call. Now, if Netflix blew by 360, always a trade-off there, right? You would limit yourself if you had a roll, and that's what the system kind of will teach you there as well. But yeah, in this particular case, worked out pretty darn well, right? Pretty darn well. Now, here's another example. Apple. Friend of most investors out there, right? Now, clearly, Apple's trying to make a move above that 175 level, but it's failed. So I came in here with 2 weeks ago to expiration. February 22nd expiration, right? At the time when I took the screenshot. And with Apple trading about 171, I gave it some wiggle room right at a resistance level at 175. And I said, all right, let's sell the 175 calls and bring in a credit of $1.28. Again, Apple stays below 175. That call option expires worthless. Well, with just still a week to go on this guy here, and again, this is what the system teaches you, I could just buy this guy. Now, Apple essentially did what? It dropped 50 cents. It was at 170.94, dropped to 170.44 at this point. So it dropped 50 cents, but you still did what? Made money. Yeah, so basically about $100. You sold that guy for $1.28, you buy back for 30 cents. So Apple dropped 50 cents, but you being a smart investor using cover calls, you made $1 on that trade in a week. Buy back, start the routine again. My mom's Comcast stock. Current position I have on. So when I took this screenshot here, this is about a month ago at expiration. Now again, not as volatile as Apple, or certainly not as volatile as Netflix here. But I'm giving it room to move higher by about $1.30. Stock is trading at 37.68. I sell the 39 call, right? Again, going to get taken away from me if I do nothing if Comcast closes above 39. Now my premiums aren't going to be in the hundreds here. It's 33 bucks. But I have 6 of these out there, right? So if Comcast just bounces around, I can do okay. Now, in this one, we don't expect a week later here, but here, I wouldn't do anything at this point. But with Comcast, it moved up 6 cents. It was at 37.68. A week later, it moved up 6 cents to 37.74. But guess what? My call premium lost value because of time decay. Now, again, I wouldn't get out of it yet, but I could actually buy this guy back and make $11 on 6 contracts. I could basically make 66 bucks for essentially Comcast moving 6 cents higher over the course of a week. Yeah. All right. And then do a cash secured put. We didn't talk about that today, and we picked kind of a ferocious one here. Amazon. So with Amazon trading at about 16.38 at this time, with just 3 days to go to expiration. So look at this on Wednesday. I looked at a support point around 1600. For cash secured put, that put expires worthless if the stock is trading at 1600 or higher in this case. Here, we brought in a credit of 360. Now again, if Amazon's above $1,600, that put option expires worthless, we keep the premium. As luck would have it, part of skill based on that potential support level there. Yeah, trading at 1605 with just, I think it was like 30 minutes left or not even left in the market here. Wouldn't even waste my time. Buy this guy back for 15 cents. Amazon dropped, whether you own the stock or not, right? Amazon dropped. You basically netted, 300 something bucks because that put option expired worthless. Yeah. No brainer, my point. So, all right, which brings us to, again, I don't like to be a big sales guy here by any means, but the system absolutely is going to make it easier for you. I promise that. It's that simple, easy to follow program. 5 easy modules. You have lifetime access to it, right? Laid out step by step on this guy here. Now, here, you get the PDF accompaniment. Sorry about that too as well. And really, it makes it fun and simple to follow a system. It's going to lay it out, lifetime access. You could always go back and review it. Now, we kind of talked about this earlier. What's this not for? Well, it's clearly not a get-rich scheme. We're not selling puts like we did on Amazon. Can you do that? Right. You have to understand the risk here, right? It's not for gamblers, for investors here. You'd rather spend your time and money than endure losses by learning a simple system that's been proven. That's the key, right? That's been proven to work. And that's the key here. Now, part of this is all the bonuses. Now, if you're brand new to options, we have this Options Impact video series. It's 30 short form videos and 6 or 8 long form videos for a complete beginner. That's thrown in there as well. And again, you have lifetime access to the S.M.A.R.T system too. So you don't have to hurry up and complete this so you can get it done. Now, I talked about a class I do. It's the most popular class. I've been doing it for almost 8 years. Every single day in the market, I'm in here, right, doing a class, and they're all recorded as well. So that's the beauty of it. you're going to attend this class and get the recordings as well. You can ask me questions about things you learned. Does this look a good covered call candidate, right? So you're going to be in this class. You're going to learn other things than cover calls and cash secured puts and collars and investor strategies, but that's part of the bonus too. So you get a whole month of that. It's an everyday class, 30 minutes after the market opens, and they're all recorded. So a big majority of people are working, so they can't attend it live, but they just watch, you know, the archive session of it as well. Now, we also have a chat room, right? And we have a bunch of different channels for different things here, but you're going to have access to the chat room as well. I mean, ask questions in the chat room, get trade ideas in the chat room, so on and so forth. So, and then first time ever done this too, 30-day money back guarantee. If you're not satisfied, 30 days, no questions asked, get your money back. Now, honestly, on this part, didn't know if I was supposed to include this in there because it was on that, because Dan did a couple presentations out of state, so on and so forth, but I just left it in there. We have, every year, we have a live training retreat. And this year, it's going to be in Sonoma. It's 3 days. It normally is 2 days. It's 3 days. It's July 11th, 12th, and 13th. So it's going to be classes and a bunch of other surprises here. Here's just a bunch. It's me, Dan, this other John that's part of our program doing all these classes. Thursday, Friday, Saturday. And there's all other traders there, right? There's all other traders going to be there. So that's just the great thing about it, is that, you know, the classes are great. Don't get me wrong. I give my all, but really it's just about being around other traders, like-minded traders, you know, and that's the great part about it. So that is also included. And honestly, on its own, we sell that for $14.97. So the total value is actually more than $36.40. I didn't add it up here and stuff, but yeah, so you get the S.M.A.R.T system, you get the beginner option series, you get the 1 month of my group coaching class, you get the chat room, and you get the retreat for $9.97. $9.97. So honestly, the retreat on its own is $1,500. and yeah, I mean, so basically you're getting essentially that discounted. You're getting the S.M.A.R.T system for free. You're getting the group coaching for free. You're getting the chat room. You're getting the options impact series. So yeah, to me, markettaker.com/smart. Yeah. So not trying to give a big sales pitch, but that's it. If you have any questions, you can email me at john@markettaker.com. If you have any questions, I'd love to answer it, but I'd love to see you in person too in July in Sonoma. I'm a big wine guy. I've been a nap in Sonoma about 50 times. So it's, I didn't pick this retreat. So everyone thinks that John picked this location. I actually didn't pick this location, but I'm not unhappy about it either. So let's say that. But yeah, thanks, Don. So any questions you have, ask me now or email me later. And come with us, Don. I appreciate it. So yeah, but I thank you so much. I appreciate it, Don. I more than appreciate TradeStation. Like I said, I barely do these presentations, so it's always a kick for me to do them. So thank you so much.
And thank you, John Kmiecik of Market Taker Mentoring. We at TradeStation really do appreciate your time today. This was an outstanding presentation. There's an awful lot packed into our hour here that some traders, it take months and months of training to even navigate. And you just got a freebie from our friends at Market Taker Mentoring. I want to just remind everybody the recording will be in place tomorrow, either on the TradeStation website in the university section, in the TradeStation YouTube page, or if you're a TradeStation user, and most of you are, you'll be able to locate this recording on the TradeStation Today app in the trading on the trading platform. So we want to thank Market Taker Mentoring one more time. And then we'll be back tomorrow for our morning market briefing, 1/2 hour before the market opens. I'll be here with Andrew Horowitz, the Disciplined Trader, and we'll be running through the things you need to look for tomorrow. Well, thanks again, John, and we'll talk soon.
Thanks, Don. Thanks, everyone.